So I will talk to you today about data ecosystem strategies in banking and finance. And I am David Gyori. I am co-author of 5 internationally published books, and I am a top 10 global thought leader and influencer on financial technology. The 21st century is the century of data, as opposed to the 20th century, which was the century of oil and gas. And actually, data as a key input resource into our economy is totally different compared to oil. Oil is additive. 2 barrels of oil have the value and the cost of 2 times 1 barrel of oil, as opposed to data, which is multiplicative. Putting data and data together creates additional value, creates positive synergies. So therefore, we have to learn this new economy, the data economy. And actually, the 20th century was the industrial capitalistic economy, and this change is very, very hard for banks. 20 years ago, 30 years ago, traditional incumbent large banks, financial services providers were the kings of data. Now we have lost this kingdom. Now the kings of data are technology giants, GAFA and BAT. What is GAFA? Google, Apple, Facebook, Amazon. What is BAT? Baidu, Alibaba, Tencent. Think about how these companies are capturing data, how these companies are storing data, how these companies are analyzing data, and how these companies are monetizing data. And compare it with banks. And when we talk about banks and data, okay, we have lost our data kingdom. The technology giants are ruling now, and we have to figure out how we can catch up, because the technology giants are coming for our clients. Increasingly, the US ones, incrementally, step by step, carefully, because they don't want to be fully regulated as credit institutions, often not even be regulated as e-money institutions. I am using now the European regulatory terminologies. Well, look at China. They are less careful entering financial services. So as a reaction, we have to get our data right. There are minimum 2 additional reasons multiplicating the importance of data. One of the reasons is open banking. What's happening in open banking? Through application programming interface infrastructures, banks are basically losing their primacy in terms of owning the holistic financial data of clients. Banks are only owning one narrow slice, one piece of the puzzle, and TPPs, third-party providers, AISPs, PISPs, and other entities under open banking or PSD2 are owning the holistic picture, or at least having a view of the holistic picture. This is very important, and this is very dangerous for us. The other reason is that we are just at the beginning of the century of data. We are just at the humble beginning. Actually, through 5G, 6G technology, through IoT, Internet of Things, data will become magnitudes richer, bigger, faster. And what's going to happen is that this data is going to be the key input resource for artificial intelligence. And artificial intelligence, with data as the key input resource, will bring this entire data ecosystem strategy to a whole new level. I mean, think about the capabilities of narrow AI. We are in the area of narrow AI nowadays. Artificial general intelligence, which is basically the copy of human intelligence by machines, is still ahead of us. But even in this era of narrow AI, deep learning is so powerful. Deep learning algorithms learned to play the game of Go, which is a 4,000 years old game, in less than 4 hours, better than the current human world champion, a gentleman from South Korea who, in return, as a reaction, retired from playing Go. He said if an algorithm can learn it better in 4 hours than humanity in 4,000 years, then I am retiring. Will we all retire? I hope not. Brad King will tell us much more about this. Thank you for getting the screen ready. I am very lucky because through this delay I got the chance to talk to you independently from the slides. So, Gordon Moore, Robert Metcalfe. Both gentlemen gave very famous interviews to different magazines in the United States in the same year, in 1974. Gordon Moore, one of the founders of Intel, in this interview prescribed what later became Moore's Law. Moore's Law, marked by blue color on this chart, means that the cost of computing, the cost of capturing data, storing data, transferring data, analyzing data, turning data into value is actually going down year by year, and it's going down exponentially. Moore's law states that the cost of computing, for example, buying a pen drive with 1 terabyte storage, is going down approximately 50% in nominal US dollar terms year on year. Think about taking 100 euros, going to the store, buying a hard drive, for example, external hard drive. 1 year down the road, you can buy the hard drive with 2 times the capacity. Metcalfe's law, Robert Metcalfe was a telecommunications engineer, marked by purple color, however, states that the value of telecommunications networks, well, back in the mid-70s, we didn't have internet, we didn't have peer-to-peer lending, we didn't have mobile wallets, we didn't have peer-to-peer money transfer, we didn't have Zoom video call, we didn't have Skype video call. So the value of telecommunications networks, this is what he could talk about back then, is exponentially proportionate to the number of users. Not only linearly, but exponentially. We also call it network effect, and it means that the more users such a digital ecosystem has, the more value it provides for each individual user. Therefore, the total value of the system is exponentially, not only linearly, proportionate to the number of users. When we put these two things together, there is a conclusion, there is a result, there is a consequence. If the value is going up exponentially, while the costs are going down exponentially, it means that there is an aggressively growing, data-driven delta of digital disruption. There is an ever-growing reason to go through full digital transition. And actually, this is displaying in front of our eyes. For Citigroup, it took 200 years to reach the benchmark, the milestone of 200 million active clients globally. For PayPal, founded by 5 smart guys, among them Elon Musk, back in 1998 in Silicon Valley, specifically in Palo Alto, it took 20 years to reach 200 million active users. They reached this milestone in 2018, 20 years after 1998. Well, how long did it take for WeChat Pay to reach the 200 million active user milestone? 2 years. 222. There is something happening here, and this something is rather exponential. And now we know the reasons, now we know the engines behind this. Moore's law and Metcalfe's law put together. This is unstoppable. It will not stop. It's an exponential process. Our only chance as bankers is to learn it and to win it. Is to learn it, to embrace it, and to win it. Now, this is the galaxy of financial technology. What is the gravitational force? What is the power holding this galaxy all together? You already know the answer. Data. Because we are in the century of data. Paytech. Channel tech payments going through emerging channels. Currently, what is the #1 channel? The smartphone. 5 years, 10 years, 15 years down the road, you will not take pictures of my slides and me with your smartphones. You will be looking at me with your smart glasses. Some of you with your smart contact lenses. In the pipeline, Google, Samsung, they know this. The smartphone is not gonna last forever. And guess what? When you have your smart glasses on, sooner than you imagine, you will see my name. You will see my LinkedIn profile. You can immediately contact me, you know, just by clicking with your eyes. I will see that. I will see that. Anyway, so payments are going through emerging channels. Payments going through these emerging channels are creating, producing ever richer, ever bigger, ever more data. ISO 20022? What is ISO 20022 about? Compliance? No. In your compliance department, maybe they say it's about compliance. But in terms of business, it's about rich data, bigger data, renewing SWIFT. Because when SWIFT was set up in 1974, same year when those two gentlemen gave this interview, very interesting by the way. So when SWIFT was set up, the objective was to produce shorter, simpler messages because we couldn't handle data. Computers in terms of hardware, software, in terms of sending data, data transfer, they couldn't handle rich data, big data. But now we are in 2022. Okay, according to Morton, we are in 2023, and Brett King is in 2053, probably. So anyway, most of us are in 2022 currently. So now we have the capabilities to produce, to capture, to analyze, to utilize, to monetize rich data. in payments? Geolocation, yes. Attaching nice pictures to payments, yes. Liking, disliking, commenting, rating, sharing, blogging, vlogging, microblogging, whatever you want to do related to a certain payment, you must be able to do it, because we are not in 1974, we are in 2022, and some of us in 2052. Anyway, based on this rich data captured from payments, we are able to provide lend tech and credit tech. Think about BNPL, buy now, pay later, the mighty reincarnation of credit cards, sorry MasterCard, sorry Visa, into the digital reality. Or think about wealth tech, robo-advisors, personal finance dashboards, open banking TPP interfaces, asset tokenization, decentralized currencies, or social trading such as eToro. Do you know eToro? They have 35 million active users globally currently. And actually, you can trade all sorts of assets with your own profile. It's like crossing, intertwining Facebook with traditional brokerage. It's a whole new paradigm. Privacy. Not for millennials and Generation Z. Of course we must be compliant, and we are, in terms of every rule related to privacy, but in terms of client attitude, in terms of the preferences of the users, millennials and Generation Z is totally different, 180-degree diagonal opposite of baby boomers, the great generation after the Second World War, focusing on every aspect of privacy, especially related to financial services. The young people are different. That's why eToro is so successful. That's why PayPal had to acquire Venmo, because Venmo, a mobile wallet where you are sending money, receiving money, buying things with your own face, with your own profile, and people can comment, people can react to your purchases, became exponentially successful. Currently there are 85 million users in the USA, and they are transacting around 250 billion US dollars annually through this Venmo mobile wallet, where everything is public. That's why it was a national security threat when they found the good old Joe Biden transacting with his grandchildren on Venmo. Not because Joe Biden likes Venmo, but because his grandchildren want to receive money from the grandfather, and they pushed the grandfather into using the platform of their choice. RegTech, very, very important. Compliance getting more complex, compliance getting more expensive, compliance getting more resourceful. We know it. Talk to your compliance department. So we must use technology not only to bump into constraints of compliance, but also to make compliance a little bit easier, a little bit faster, a little bit more efficient. That is the major area number 6, RegTech. And then some mega trends in category number 7, from core banking tech changing your engines mid-flight, fixing your bike while riding it, you know, this is like the impossible exercise, to quantum finance or environmental, social and governance trends using technology in finance. Now, all in all, there are 10 major dimensions of a new banking market being born in front of our eyes. Number one, new players on the supply side. Think about Google, Apple, Facebook, Amazon, Baidu, Alibaba, Tencent, but think about the 50,000 fintech startups. Think about the neobanks, digital-only banks. Think about ride-hailing services in Southeast Asia. Gojek, Grab going into financial services. Think about mobile network operators. 54 countries on the beautiful growing continent, the youngest continent in terms of demographics of Africa, and there are over 20 of these 54 current sovereign countries in Africa where more adults use mobile wallets than banks. Okay? And I can go on and on and on. So there are new players on the supply side. That's dimension number one. There are new players on the demand side. Millennials. Who are millennials? People who turned adults in the new millennium. Who turned adults in the new millennium? People who were born in 1982 or later. Who were born in 1982 or later? People who are currently 40 or younger. Well, supposing that we are really in 2022. Anyway, who is Generation Z? Generation Z is the people who were born after 1996. So millennials are between 1982 and 1996. Generation Z is even younger. They were born after 1996. New products, mobile wallets, robo-advisors, BNPL, augmented reality applications. I can go on and on and on. Think about digital product development. By the way, in its heart, in its core, digital product development in banking is always revolving around data. And what is data revolving around? Clients, luckily. New channels. Think about voice banking, very popular in the United States. Think about the smart glasses or smart contact lenses or VR or smartphone or TikTok or Snapchat or, you know, new channels are popping up month by month. New business models. Well, the margins on payments globally is shrinking, so we must learn to monetize the data captured from payments. This is a new business model. I can tell you many other new aspects of new business models in banking. New risks. Look at the cryptocurrency bubble bursting in front of our eyes. Or think through the cybersecurity aspects of all these 40 areas listed on this slide. All of them are beautiful, but all of them are risky, and cybersecurity risks are on the rise. Think about new technologies such as artificial intelligence, such as blockchain, such as behavioral biometrics, continuously, seamlessly, multi-factor identifying all of us. The solutions are there. We just must learn as banks to implement those in a compliant way. Probably regulators also must learn about this. Number 8, new adoption curve. What is the new adoption curve? The new adoption curve of financial services is not the good old linear adoption curve. It's exponential. Can you remember? Citigroup, 200 years, PayPal, 20 years, WeChat Pay, 2 years. There is a new technology adoption curve, which is predominantly exponential, starting to rule financial services. And we must learn that. New market structure. Think about open banking. Open banking and API ecosystems in general are de facto forming a new market structure in front of our eyes. And then number 10, the new key input resource, data. Well, oil plus oil, linear. Data plus data, exponential. Look at Pop-Tart. I could bring an example from deep learning. I could bring an example from genetic algorithms. I could bring an example from deep neural networks running nonlinear mathematic functions. Instead of all this, I am bringing a very simple example. Pop-Tarts. Not very healthy though. Don't try. Walmart is capturing a lot of data. And actually Walmart started to play around with this data. For example, putting sales data and weather data together. You know what turned out? It turned out that when there is a hurricane coming, the sales of Pop-Tarts goes significantly up. We don't know why, nor do we want to know why. It's enough to know this correlation, and we can turn it into money. So let's turn sales data and weather data put together into additional profit, everything unchanged. What is the way? Next time a hurricane warning went public, Walmart put the Pop-Tart display to the front of the stores. And you know what happened? The sales of Pop-Tarts went up even more. Easy peasy. Anyway, just something interesting. Payments are special forms of communications. And if payments are special forms of communications. By the way, think about the name of SWIFT, Society for Worldwide Interbank Financial Telecommunications, okay? So there is a strong suspicion that payments are about communications. And if they are, then the same thing must happen to payments as it happened to telecommunications. And what happened to telecommunications? What is the business in telecommunications now? Landlines? No. Voice? No. Local phone calls? No. International phone calls? No. Data. Data is the business in telecommunications. Therefore, data must become the business in payments as well. Telecommunications, maybe you don't remember because you are very young, but telecommunications used to cost money. For example, there is Sir Alexander Graham Bell making the first intercontinental phone call in 1927, costing, well, then they rolled it out to the market, and it was costing at the beginning $75 per 3 minutes. That was like half the cost of a new car, okay? And then Moore's law kicked in. And year by year, everything unchanged. In nominal US dollar terms, the cost of intercontinental phone calls went 50% down. And now if we want to talk with someone from around the world, what do? We jump on WhatsApp or jump on Zoom or Skype, and marginally it costs 0. Okay. By the way, on the left side, a real advertisement from 1918, from the time of Spanish flu, that is about local phone calls. On the left side of the slide, look at this. When in quarantine, Spanish flu, not COVID, Spanish flu. When in quarantine, people who are in quarantine are not isolated if they have Bell telephone. The Bell service brings cheer and encouragement to the sick and is of value in countless other ways as well. Friends, whether close at hand or far away, can be easily reached because Bell service is a universal service. Okay? Now, the only thing that remained is data. Therefore, in banking, the same will happen in a couple of years. You can monetize data directly, or you can use data and build assets as well as liabilities on top in a smart way. And based on those assets and liabilities, what is your bank going to earn? Net interest rate margin. Because net interest rate margin has been the #1 key profit driver in banking. The gentleman is nodding. He's a real banker in the past 4,000 years. Ever since grain loans in Assyria. You are right. I am biased because I am saying the same. So anyway, okay, after 2008, we had a period of de facto zero interest rates in major economies across major currencies. But that never lasts forever. And actually, net interest rate margin is strongly correlated positively with the level of nominal interest rates. So when interest rates go up, the net interest rate margin earning of traditional licensed credit institutions with large assets and liabilities de facto leveraged will go significantly up. And it's happening in front of our eyes. Now, the new players coming to banking, what is their advantage? Their typical advantage is their data skills. We have lost our kingdom of data. Fintech startups, neobanks, digital-only banks, gaming companies. Think about Tencent, or think about the newly distributed digital banking licenses in Singapore. Ride-hailing services, mobile network operators, even some airlines. Think about AirAsia, the largest low-cost airline in Asia, going big time into financial services through a subsidiary called BigPay. Google, Apple, Facebook, Amazon, Baidu, Alibaba, Tencent, they are now better in data than typically large traditional incumbent banks are. We must up our game unless we want to answer the question, what happens to traditional banks in 5 years and what happens in 15 years in a negative way. But I want to answer it in a positive way. I think we will learn it, we will master it, and we will win it. And this is just the beginning, as I told you. 5G, coming. We are at the beginning of 5G, not full capability. That will be 3 magnitudes wider in terms of data capabilities than 4G used to be. 6G is already in the pipeline, new Wi-Fi protocol. What is going to happen? All this additional data transfer capability will open up a new dimension of banking, augmented reality and virtual reality, AR and VR. What's the difference? AR, physical reality with an additional digital layer of information on top of it, versus virtual reality, totally imaginary. I am sitting on a roller coaster ride, okay? Totally digital. Both of these belong to the wider category of spatial computing, extended reality. And by the way, what is MR, mixed reality? MR stands for devices which are capable of doing AR mode and VR mode. We can flip between the two modes. Some people think that AR is the future of smartphones, while VR is the future of desktop, laptop, and tablet. Let's leave this question open. I don't want to bring you into quantum teleportation and other things, because, you know, we are here to make profit and our shareholders would freak out. Anyway, there is a long-term trend of screen size transition. Cinema large, TV smaller, desktop smaller, laptop smaller, tablet smaller, smartphone for the smartwatch too small. So what is the next step after smartwatch? The screen must disappear. And the screen can disappear in 2 major ways. One way is VR. The screen substitutes reality. The other is AR. The screen augments reality. Here is the smart contact lens. There are startups, there are technology giants developing it. Maybe you can take photos with your new smart contact lenses in the next Amsterdam banking forum, or the next, or the next. Very soon, within weeks or maximum month, what's gonna happen? Apple is going to come out with the smart glasses. And Apple's smart glasses cooperating with iPhone, cooperating with Apple Watch will be a game changer. And our banks will begin, finally, to develop applications for augmented reality. Meanwhile, in China, for example, under Ant Financial belonging to Alibaba, VR Pay, virtual reality payments, are up and running for 5 years now and growing beautifully. You navigate yourself into the VR version of online commerce with your VR glasses, and every street is a product category, like books, cosmetics, electronics, whatever. Every building is a brand, and you navigate yourself inside the building, and then you focus on a specific product for more than 1.5 seconds, and then you blink, and detailed information about the product comes up, and then in this detailed information is the price, and then you start to focus on the price for more than 1.5 seconds, and then you blink and you initiated a payment. And it's going on. But there is a guy, okay, his name is Elon Musk. You know him. way too well. So there is a guy who always says, wait a minute, hold my beer, David. He unfortunately doesn't talk to me. I don't have the chance to talk to him. Maybe it's better, maybe not. But anyway, I am just imagining that he's saying, wait a minute, David, hold my beer. You are talking about AR and VR. But I have a better way. I have an even more disruptive way. The screen, the interface, is going to be inside us. Brain-computer interfaces. Brain-computer interfaces. This is what the gentleman is working on in the background under Neuralink. Luckily, at this point, he's experimenting with animals. What is the brain-computer interface? Cyborgs. Mix of humans and machines. What is the brain-computer interface? Transhumanism. And guess what? Maybe 20, 30, 40, 50 years down the road, it will not only be cyborgs, humans like us with some computer chip in the brain, using our banks. It will also be intelligent machines. You know, why machines couldn't hold assets and liabilities? Of course they can. I am not a regulator. They will later decide. But when your bank in 2040 opens its machine banking business unit, don't be very surprised. Because data is turning into big data. Big data is turning into very big data. Very big data being driven through artificial neurons. What are artificial neurons? Sigmoid, mathematic, computer codes mimicking the way our biologic neurons work in our brain. And when we order these artificial neurons into layers, and when we use more than 3 layers of them, we call it deep neural networks. And these deep neural networks, combined with level 4-5 of machine learning, because level 4-5 of machine learning is the current cutting edge, is actually very, very powerful. How much time do we have? I need a little help here. What time is it?
8 minutes.
I still have 7 minutes. That's wonderful. Okay, because actually I thought there is a clock there, but there isn't. And my augmented reality glasses, well, these are real glasses, simple, not AR yet, are not displaying the precise time, maybe next year. So, level 1 machine intelligence, systems that act, if then, level traditional software, level 2 still traditional software, systems that predict if your balance is going up 10,000 euros per month, soon we will have to send you a premium banking offer. Level 3 still traditional software, systems that learn. After we sent out 1 million premium banking offers to clients whose balance is going up sharply, it turns out that most of them are collecting money to have their collateral for a mortgage, their down payment. So it would be better to send a mortgage offer to them, okay? Systems that learn. Next round, we can optimize it. To the young people, we send mortgage offer. To the older people, we send premium banking offer if their balance is going sharply up. Level 4, that's already narrow AI, narrow, artificial intelligence, systems that create. This is software 2.0. They can rewrite their code. Genetic algorithms. Genetic algorithms learned Go and learned chess very, very fast, better than humanity. Go on chess websites. Everyone is interested in the machines. Level 5, systems that relate. Level 5, systems that relate, know everything of level 1, 2, 3, 4, plus they can estimate your emotions. Like, he is excited to listen. He is agreeing but critical as well. He is curious. I don't want to point to anyone, is a little bit tired. You know, things like this, primary emotions, secondary emotions, and can relate to it. You know, imagine an automated call center which recognizes that someone's insurance claim was fraudulent. Not from the logic of the claim, but from the emotional status based on 150 voice vectors of the call. And then there is level 6, only theoretically. Publicly, we don't know about any up and running solution. That is systems that master. What does it mean? Systems that can transfer knowledge from one area to the other. For example, we create an AI to write operas. And it writes wonderful operas, better than Puccini, better than Verdi. The AI version of Tosca and La Boheme is already created when the algorithm, all of a sudden, comes up with a Shakespeare sonnet. Because it mastered that area as well. And then it learns to recognize and give advice to cure cancer better than any current human doctors. Why? Because there are 200,000 new publications on cancer research per year globally, published in 110 different languages in journals. And which doctor has the time to read 200,000 publications in 100 languages per year? No doctor. And then, level 7, systems that evolve. What is this about? These are systems in the future which are able to extend their hardware. These are robots building robots. Have you seen some movies around this? These are robots repairing themselves. These are machines extending their hardware. Kasparov, how many chess rules, what to do in different situations, did he memorize when he was at the top of his game? Now he's a little bit tired. Still pretty good, though. You know, 10 million, approximately. When you can memorize 10 million things, you maxed out human intelligence, pretty much. Well, at least the magnitude. To memorize 20 million, maybe someone will come. Maybe it will happen. But to memorize a magnitude more, 100 million, impossible. By hardware. We would need larger heads. Do we want larger heads? You know, just to be more intelligent. Anyway, what is not good for us to grow bigger heads, to extend our hardware, is good for machines. They will physically extend their own hardware. That is machine superintelligence. That is the Go guy. This is young good fellow with the generative adversarial networks. So when machine intelligence, marked by M, reaches approximately the same level as human intelligence is currently, that is the point of singularity. We are approximately equally intelligent compared to machines. We are not yet there, machines are not yet there, but their intelligence is growing faster than our intelligence. So after the point of singularity, what must come? Machine superintelligence, because machines reached the point of singularity on a steeper learning curve. And what is machine superintelligence? According to some people, it's amazing. According to some people, it's beautiful. According to some others, for example, Professor Nick Bostrom, it's very dangerous. He says, machine intelligence is the last invention humanity will ever need to make. Why? Because intelligent machines can wipe us out. When we are headed the wrong way, the last thing we need is progress, he says. But some other people think different. Mark Zuckerberg likes strong artificial intelligence. Masayoshi-san, the richest guy in Japan, the richest gentleman from Japan, he says machine intelligence will be wonderful. Machine superintelligence will be great. Why? Because if machines are more intelligent than humans, then machines will want peace. Why? Because intelligent humans also prefer peace. Everything unchanged. Is it a little bit naive? Yes, but it sounds great. And what does this gentleman again do on my slide? He says again, hold my beer. If machine superintelligence is coming, what is the remedy? What is the way to make sure that machines cannot wipe humanity out? To combine machines with humans. She already knows the answer. And this is the secondary goal behind Neuralink. Anyway, when it comes to data, there are beautiful strategies, honestly, for traditional, incumbent, large, market-leading, compliant banks to utilize it. I have listed 7 of these. Co-petition, front-to-back API platformification, open banking API platformification, full API platformification, social platformification, self-platformification. I have 2 minutes, or I am 2 minutes overtime. Both, amazing. 2 minutes overtime and having 2 minutes. I am lucky that in my AR glasses I saw Morten communicating with me through this intelligent sign language. So anyway, and then there are mixed data ecosystem strategies, which are mixtures of the first 6. Now, I still have 1 minute to explain those 6. Co-petition. Cooperating with your competitors. Why? Because data is synergetic, not like oil. In oil, it's a zero-sum game. You need to compete. In data, you need to cooperate with your competitors. Think about Wise, think about PayPal, and so on. Front-to-back API platformification. One interface, one bank in the background. Open banking API platformification, we know about it, we struggle with it. Full API platformification, Starling Bank, UK, plain vanilla product in the middle, external partners through APIs connecting. Now, my time is up. So in the next Amsterdam Banking Forum, I will tell you about social platformification and self-platformification. Thank you for your attention. And also try to join this Banking Renaissance Retreat 2023. It's gonna be amazing. Thank you.